NSE lecture series on securities laws and practices. As you already know, the topic of today's lecture is Reits and Invades, and it will be delivered by Mr. Kranti Mohan. Mr. Mohan is a partner in Cyril Amarchand Mangaldas at the Mumbai office. His area of expertise is equity capital markets. Mr. Mohan has been associated with a number of capital market transactions, including IPOs, QIPs, rights offerings, and overseas listings. He has been involved in several pioneering capital markets transactions involving India's leading companies and with the work related to the firm's representation on various regulatory committees. Mr. Mohan has also been actively involved with various aspects of Invades and Reits. Please welcome Mr. Mohan on stage.
Okay, I can do it from here. Hi, good evening, everyone. It's quite good to see that people are interested in REITs and Invades. I've invested almost 6 last years in trying to see this product being introduced in India. As some of you might be aware that similar products were being offered in other jurisdictions such as Singapore, Hong Kong. And around 2010 to 12, a lot of Indian companies had sort of tried to list business trusts through that route or REITs in Hong Kong, Singapore. For some it worked out, like Religare Healthcare Trust. They had a successful listing and it's still listed in Singapore. But there were many other Indian corporates who faced a lot of problems getting listing completed in Singapore, particularly because the regulators there, for 2 reasons, and which are quite justifiable. One, that unlike ADRs, GDRs, etc., or other listings that happen of Indian corporates in Singapore, in business trusts, the retail public can also participate in Singapore. And therefore, they put the SGX and MAS both put a very high premium on risk or avoiding or mitigating all risks involved. And secondly, there's a cultural sort of mismatch on how our country is governed and Singapore is governed. In Singapore, everything is in black and white. In India, all of us are aware everything is in gray, whether that's related to land titles or regulatory approvals or how people renew their approvals, environmental matters, everything. And because of which Singapore used to put a very high premium, risk premium on Indian issuers and required them to mitigate all the risk. And some of these concepts we'll discuss later on, but they required Indian sponsors to provide indemnities on trivial matters, ROFO arrangement, which were very watertight, opinions from Indian councils which are disclosed in the offer document, which is sort of unheard of in any jurisdiction. So if you open the first risk factor of Religare Health Trust, you will see that our firm has issued an opinion that the entire structure is FDI compliant and not in breach of FDI laws and all of that. So because of all of these things, there was always a vacuum on why such products cannot be introduced in India. And SEBI had attempted in 2007, I think they had made the first attempt to introduce REIT kind of structures. But unfortunately, they try to do it through the mutual fund route. And as we go through this presentation, some of you might have already been, would have gone through the preparatory materials. You will see that the structure is quite similar to how a mutual fund works, but not entirely so, because the unit holders have more participative rights than they would have in a mutual fund. So in 2007, SEBI attempted to introduce this through the mutual fund route, and that didn't really work out well. And finally, after a lot of deliberation, etc., now we have a robust REIT Invert regulations and a framework governing it. Of course, there are certain issues, and that's addressed in the last part of the presentation, that still need to be addressed, whether that's the investor set that can come in today, whether they're eligible or not, or whether it's the units itself. What is the legal status of the units of a REIT or an Invert in India under the current framework? So with that as the background, I'll start with my presentation. And I would be happy to address any questions that come to your mind during the course of the presentation. We really don't have to wait for a Q&A session for the last 15-20 minutes. If you have any questions, just please feel free to ask on at that relevant point. I think most of you would be, I hope, would be familiar with our firm, so I'll skip the initial introductory slides and straight away get to the substantive portion. So just to lay some bit of groundwork to give an understanding on why come up with a form of business organization which is very different from a company. We already have a company. Why can't you list a company? Why do you need? And what is the genesis of this entire product? Where did it come out from? So like all innovative things in securities market, the genesis of business trust as a corporate form of business organization is also was initiated in the United States. In the early part of the last century, when industrial revolution was generating a lot of excess sums for companies, they had difficulty in investing those amounts in real estate assets, because there was a restriction that a company cannot hold any land other than what is required for its business purposes under US law. So they came up to utilize the surplus cash and invest it in real estate. They came up with the business trust structure where there was no such restriction. On top of that, trust structures typically are tax pass-throughs. So that was an added advantage, and that's where it actually started. And the initial one of the first few business trusts was set up in US in 1920s or 1930s. From there, where like a general investment, it evolved into a more specialized form, which is the real estate investment trust. And that market picked up after the 60s in US, where the government introduced even more tax incentives for REIT structures. And now today, the United States has the highest number of listed REITs anywhere in the world, and with significant market capitalization. And the second reason for having this product is, unlike a corporation, where if you have to pass on the profits of or profitability of the company to your shareholders, you need to have accounting profits. That's common across countries or jurisdictions which follow common law, and it's not unique. That puts you, that comes up with its own difficulty, because a lot of times there might be surplus cash flows, but you can't reflect it as accounting profits because of non-cash items, etc. However, in case of a trust, there is, under any trust law, there is no such requirement. So you could actually utilize your cash flows to make distribution to your unit holders instead of just the dividend payout, which is available in case of a company. So, and however, you could not have just a plain vanilla listed trust. You need to give it a color of a company also. And in that terms, this is more of a hybrid product, because it has elements of a company incorporated under the Companies Act or the relevant Companies Act of each jurisdiction. For example, unit holder rights. Lots of decisions have to be approved by unit holders at their meetings. Then they have rights to address oppression and mismanagement. These kind of rights which are not available typically in a trust, where the beneficiaries are completely hands-off. They are only interested in terms of the trust deed, whatever outflow goes to them, and everything is controlled by the trustee. Whereas here, the unit holders have a more participative role, where they can influence the decision making and the direction that the listed trust takes. So in that sense, it gives you the best of the both worlds. One, you have a platform where you have assured income, or at least a projection of assured income over a period of time, because the assets that typically go into a business trust or a REIT are those which are which have long-term arrangements which guarantee their cash flow. So whether that's a PPA or a long-term 20-25-year lease arrangement, or your concession agreements under the in relation to road projects, where whatever you earn is sort of over a horizon of 20-25-year period is already visible, and you need to provide under the regulation projections for 1 year, but an investor can gauge how his distributions or his income from these products will come. Unlike a company where this certainty may not be available, because it could be a mix of products that go. And that's why business trusts and REITs will only have, for REITs as the term itself says, is real estate investment trust, but on business trusts you will always see infra companies setting up business trusts largely with long-term earning arrangements for them. So that's again, so a mix of these reasons why this product was required in India, because there's a huge, the government has been putting a lot of emphasis on infrastructure development and all, and this provides another avenue. It also gives the investor, an investor may not have enough money, a retail or a small scale investor to invest in a big commercial real estate project, but he can participate in that by buying in or subscribing to units that are made available by this REIT structure. So that's where the genesis and why India needed this product. And it was also leading to, in some ways, externalization of Indian capital markets. Why not have a product in India where Indian investors can also participate? And we will touch upon that later on, but it's a product which is very well suited for, say, insurance companies and pension funds. So why should the domestic insurance companies or pension funds not able to take benefit of such a product? And so therefore the introduction was very timely. In its essence, and this is very important before we go into nitty-gritties of REITs and InvITs, it's very important to remember that in its essence, it's a trust registered under the Indian Trust Act. The Indian Trust Act will govern everything, whether you enter into investment management agreement, what a trustee can delegate, what is trustee liable for, what are the benefits available to unit holders, what are their rights. The umbrella legislation and Invert REIT regulations cannot be in breach of what the trust law provides. They cannot be contrary to that, and that's why we need to go back and look at trust law each and every time. And if you're acting on any of these or working on any of that InvITs and REITs, it's of paramount importance that you keep it at the back of your head that you have to consult, evaluate the implications of the trust law. And this, in the course of the transactions that we are doing, we have seen that people forget that quite a bit, including lawyers like us who sort of forget that Indian Trust Act plays the most important role in all of this. In accordance with the InvIT and REIT regulations, a REIT or InvIT has to be set up as a trust established under the Indian Trust Act, and it has to be registered under the Registration Act. And like I mentioned earlier, this requirement is broadly similar to what you have for mutual funds, where also it has to be set up as a trust and then registered under the Registration Act. So broadly the structure is similar and most of you would be familiar with it. The second part is that there are certain restrictions on the kind of activities or kind of assets that this trust can own, and that we will deal with as we go further. But this is a specialized kind of trust established under the Trust Act and giving its unit holders some specific special rights. In terms of instrument, the second part is the units. In terms of instrument, there's a huge debate that's still not been laid to rest, whether it's an equity instrument or whether it's a debt instrument. And I'd be happy to, if any of you have a view, I would be happy to hear that. What do you think? It is an equity product or a debt product? And that's a question for NSE also, in fact. Where are you going to list it? On the debt segment or on the equity segment? So it has elements of both, and it's a hybrid product. If you had to do it in a classical manner, you will have a separate segment for it, and which for similar kind of products. But I think that's unlikely to happen. And whatever indication we have got from SEBI till now, including their press release, recent press release where they have, and followed by the notification where they have allowed mutual funds to invest, they've emphasized on the fact that it's more like an equity product than a debt product. In the market, in our practical experience, what we are seeing is the bankers and other intermediaries are marketing it according to the strategies that suit them. So if they have a large investor pool who would be interested in this product, but who view it as debt, they are marketing it as debt. If their relationship guys want an equity investment, they're marketing it as an equity investment. And each investment banking house has a different sort of view on it. But I think some of that needs to get streamlined now. And again, stock exchanges will have to take some kind of role in that. Elsewhere, so they have they treat it as a hybrid product. So they have a separate classification for it as a hybrid. Correct. So they have just one segment. So really that question doesn't come up for them, but that question does come up for some of the investors, say a mutual fund, whether, and that's a question in India also, whether I come through my, if I'm a mutual fund, whether I come through my debt scheme or I come through my equity scheme. Again, so the answer is ideally both schemes should be able to invest in this product, but really there should be a third segment that this is a hybrid product, and there should be separate investment norms that should be applicable to this product. But right now, I think what SEBI has said and the way they have drafted the notification, the mutual funds are free to determine. It's left to their judgment how do they want to treat it, whether as part of their debt portfolio or equity portfolio. We touched upon the next question, the question on why do we need REITs and InVITs we sort of addressed, and also what are the units of REIT and InVIT. But this question is vexing everyone. So I think if you're working on transactions or otherwise discussing this is one important point that you should keep in mind. So yeah, but for units of REITs and InVITs, they have not gone into treating it as equity or debt. For the benefit that they are providing, they're treating it as units of business trust. So there, at least the tax guys are clear that I'm not going to make a distinction between equity and debt. This is a unique product. It's a unit of a business trust, and I will give whatever benefits are available to the units of a business trust rather than calling it an equity or debt. Sorry? Yeah. No. Yeah, units of business trust, but no. Yeah, it should not matter, but it will not be a problem when you're establishing the trust. But there's a problem that's going to happen when the unit holder is taxed, because the distributions that are made to a unit holder comprise of two things. One is the dividend that the InVIT gets or the REIT gets from its SPVs. That's one stream, which is equity. And second is normally, and we'll discuss this structure in detail, but the InVIT will infuse some debt to take out all the cash flows from the SPV. So part of the distribution will come from dividend distribution, part of it would be interest servicing. Now, the trust is a pass-through, but in the hands of the unit holder, whether you will tax it for interest income or dividend income will be a question. And that's again a question that will have to be answered by InVITs and REITs, because when they make distributions, how are they going to categorize it? Are they going to, and we have discussed this in detail with auditors, they also don't have an answer whether when you make the distribution, you will classify it, I'm paying you 100 rupees as distribution, 50 of it is equity, 50 of it is debt, and you get treated differently. Or you will just say distributions, but that's a question that remains unanswered, but it's a problem in the hands of the unit holders, not while setting up the structure, where for example, the DDT exemption and all are based on units of business trust and not really on whether it's equity or debt. Even capital gains and all, they've used the term units and not gone into equity or debt or anything. So they've been specific to that extent. This is the typical structure of a REIT or an InVIT. The only difference here would be if you see that one box on the bottom left is the project manager. That's one entity that's not required in case of REITs. That's only required in case of InVITs. And on the roles and responsibilities, we'll discuss them in the succeeding slides. But broadly, what you have is sponsor is on the top left. He is the settler of the trust. if you use the terminology of the Trust Act. And he's the one who not only provides the initial corpus, but also the assets of the trust. Unit holders, of course, are the public unit holders. Trustee, because the trust itself does not have any legal existence, everything is done or owned by the trustee. So the trustee is actually the title holder of all the assets and holds it for the benefit of the unit holders, not on behalf of unit holders. That's a very important distinction to remember. They hold it for the benefit, not on behalf of. Ownership vests with the trustee and no one else, and therefore, when you discuss various agreements on a transaction, it's important that the trustee should also in some ways be a signatory to all those contracts, including the offer document, even though SEBI in its wisdom has required only sponsor and the investment manager to sign the offer document. Then the third one is the investment manager, which has the most critical role of managing all the assets, etc., and the project manager. Let's go to the next slide so that we can sort of discuss each of their roles and responsibilities in more detail. Like I mentioned that the sponsor of the trust has very limited obligations after the trust gets listed. Yes, that's one of the key requirements that the sponsor has to. There are two things that the sponsor needs to do, two big obligations that the sponsor has. One, that it has to transfer 100% of its ownership in the SPVs or the assets to the Invade, unless there's a legal restriction. So for example, in your road concession agreements, there will be shareholding transfer restrictions of 24, 36 months, whatever, depending upon state to state or NHAI. And if there's any such restriction, then the sponsor can transfer what it is entitled to freely transfer, subject to a follow-up requirement that they will have to enter into a binding agreement whereby they cannot have any better rights than the Invert. Invert will have superior rights under that shareholders agreement or whatever form of agreement they enter into to ensure that the interest of unit holders is protected and the Invert can ensure compliance with the laws that it is subject to. That's one big requirement on the sponsor. The second one is their equivalent of promoter's contribution, if you're more familiar with the term because of equity IPOs. It's not really sponsor contribution, but sponsor lock-in. And it's different for both REITs and InvITs. SEBI in its wisdom has made it more stringent for REITs compared to InvITs. In InvITs, the sponsor on a post-issue basis is required to hold 15% of the units for a period of 3 years. And if they have more than 15%, then the balance is locked in for a period of 1 year. But after the 3 years elapse or 1 year elapses, there's no requirement for minimum holding or anything. They could actually very well, after the 3rd year, divest completely and continue to be named as, I'm not too sure how that will work, but they could continue to be named as a sponsor without any unit holding interest in the entity. Whereas in case of REITs, the requirement is that they have to hold at least 25% for a period. The sponsors have to hold at least 25% for a period of 3 years. After 3 years, for perpetuity, they need to hold at least 15%. And with each individual sponsor holding not less than 5%. So firstly, each sponsor has to give a minimum commitment, unlike in Invert, where if you have 3 sponsors, just one could be holding the entire 15% and you're fine. Here, each sponsor will have to hold at least 5% and forever. So if they want to divest, then the new guy who they sell it to has to be redesignated as sponsor, and you have to give an exit option to the dissenting unit holders. So that's a very, very high bar and very stringent requirement, which is not seen even in your equity shares. Now, shareholding requirement is not there. Even the concept of promoter, SEBI has introduced how you could go ahead and do a depromoterization, and we have seen in recent past many companies which are without promoters also getting listed. But that flexibility is not available for InvITs and REITs. Rightly so, because you do need to have a settler or a sponsor of the trust, but the shareholding or unit holding requirement is quite stringent. So these are the 2 big obligations of the sponsor, and an initial, it's not a regulatory requirement, but an additional commercial requirement that comes up in all these structures is, see, if you're talking about real estate or even for, of infra projects or even for real estate, the life of the project may be limited. Your lease may be, in case of real estate, 30, 35 years also, and you can flip that asset into a REIT structure. In case of infra projects, it will be 20, 25 years. Residual life might be even less. So the Invert doesn't have certainty what happens after 15 years, and that's why commercially investors expect that the sponsor will provide some kind of a pipeline arrangement, whether that's through a right of first offer or a right of first refusal or a call option to the Invert. But some kind of arrangement is expected where if the sponsor is developing, say, 5 projects right now, it gives some visibility that I will offer these projects over next 2-3 years to you as they mature and they have completed. That's not a legal requirement, but I would be very surprised if a REIT or an Invert happens without that requirement being in place. Trustee has the role what a typical trustee, you would be familiar with the role of a trustee plays in, say, in case of debentures or security arrangement related to financing. Here, the role of trustee is actually way more than that. So when the trustees signed up, is there anyone from any trustee company here? No. Okay. Then I can be more candid. So when the trustees signed up for this, they did not properly evaluate that this is not a security trustee role. It requires a lot of active involvement from them because they need to supervise not only the investment manager, whether it's discharging its obligations properly under the regulations or not. It also has to supervise the project manager, and in case they are failing up in discharging their obligations properly, the trustee is liable to inform that to SEBI and bring it to SEBI's attention. So all trustees will need to have an active monitoring or compliance teams in place to ensure that all supervised properly. And the regulations provide also that trustee can ask for periodic reports from investment manager and project manager, but they have left it to them where what should be the periodicity of those reports, what should be the content of those reports, all of that. And in our experience working on the Inverts and REITs that we have not seen that trustees, now some trustees have understood and they're better appreciating, they're putting systems in place, but they've still not reached a level where if I were their advisor to tell them that, yeah, you'll be fine, you'll be safe. So that's the role of the trustee. And then the investment manager is the most important intermediary in this entire structure. The investment manager does everything, whether that's deciding on acquisition or sale of assets, whether it's making distribution to the unit holders, whether that's undertaking a public offer, private placement, or any further capital raising, what indebtedness to have, addressing shareholders' queries, organizing AGMs, EGMs, and other meetings, and the entire gamut of work that in case of an equity IPO would be done by the issuer company is actually done by the investment manager in this case. And then lastly is an intermediary or an advisor called project manager, which is a requirement only in case of infrastructure investment trusts and not in case of REITs. And project manager broadly is the O&M contractor. And we will see that as we go further, we'll see that in Inverts you could also have under construction projects, and if you have a huge portion of under construction projects, then project manager could also be the EPC contractor for that. For all these entities, the regulations require some minimum eligibility requirements. I think most of you would be familiar from the preparatory material what those eligibility requirements are, but just to broadly touch on them, one is that the sponsor should have a net worth of 100 crores and a 5-year experience in infra or real estate, depending upon whether it's a REIT or Invert. Trustee should be a debenture trustee registered under debenture trustee regulations and should be independent of the sponsor and and the sponsor group. Investment manager, 10 crore net worth is required, along with the same experience requirement of 5 years on the investment manager itself, and it needs to have 2 employees who have at least 5 years of experience in infra development, fund management or advisory. The only distinction, and this is one of the issues, because the requirements, eligibility requirements for an investment manager in an Invert and those of an investment manager under a Reit are slightly different. And this is one of the issues that most of the infra developers, when they're setting up an Invert, they face. But I'm not going to discuss that now. That's one of the issues, and we'll take it up right towards the end when we are all familiar with the entire structure. Project manager, there are no such eligibility requirements, so to speak. The only requirement is that if the concession agreements provide that A, B, or C has to be the project manager, then you have to continue with that. Other than that, you can put any entity in place who can act as a project manager. And in live deals, we have seen instances where the sponsor itself is the project manager also. And that's how they continue to maintain the relationship on an ongoing basis also. The second question is, when we are setting up the Reit, or an Invert, what are the assets that can go into a Invert or a Reit? In Reit, it has to be real estate assets which are completed and revenue generating. Now, SEBI has given a relaxation in the amendments that they came up with on November 30th, I think, where they've said earlier requirement was that the 80% of the value of the assets should be in completed and revenue generating projects for a Reit. Right now I'm talking about Reit. 20% can be in other avenues, out of which only 10% could be in under construction projects. And 10% you could invest in securities, money market instruments, etc., whatever you want to invest in. Now SEBI has liberalized that and said that 80-20 is the ratio you can have. So therefore you can have 80% in completed revenue generating, and the entire 20% bucket you could have in under construction. Even though this goes against the philosophy of Invert and Reit as a product, because the concept is regular income generation, regular cash flows from your SPVs. So if you are under construction, you are taking the execution risk for those under construction projects. Then you will go and invest in a plain vanilla equity company. There are many listed real estate companies. If you want to take that execution risk, you'll invest in that and not in a product like this. And that's why SEBI has also capped it to 20% right now. In other jurisdictions, comparable jurisdiction, this is a voluntary requirement, but again, no one allows between 10-20% in under construction projects. And why people want to put under construction is not only to get rid of it, because their involvement will continue till it becomes operating and revenue generating. Why they put in is to give a slight kicker, a little element of speculation to the prospective investors, that after a point I can see that there will be some appreciation in the distributions that they get. And a lot of times the sponsors mitigate. If they put a huge chunk of their assets are under construction, there are mechanisms that they use to mitigate the execution risk. So for example, in Religare Health Trust, one of the hospitals that they had put in was their hospital in Gurgaon, Fortis Hospital in Gurgaon. At that point, it was under construction. So what the sponsor said, that for next 3 years or till this hospital becomes completed and revenue generating, I will not take any distributions on the units I hold. Whatever distributions I am eligible for, all those distributions can be made to the other unit holders. So similarly, you'll have to put, if your portfolio includes a lot of under construction, then the sponsor will have to come up with something to mitigate the effect of that. In case of Inverts, it's slightly different. In case of Inverts, on Reits, just one more thing. SEBI has also, earlier it was a definition, real estate was very tight definition. Now they have allowed some of the infrastructure related aspects also to be flipped into Reit, as long as they are captive to the real estate project you are undertaking. So if you have, you provide some sort of property management services, etc., and you want to flip it in, or you have captive power generation for that commercial real estate project, you could include that in the Reit. So those kind of things, or a hotel or a convention center. If you've built up a big IT park, it also includes a hotel and a convention center, then you can put those assets also into the Reit. Unlike earlier, because what SEBI had said, that whatever can be put under whatever gets covered under the definition of infrastructure cannot be put into a REIT. Now they have liberalized that a little bit. Captive infrastructure to a real estate project can go in. And in terms of InVITs, the position is slightly different. In InVITs, again the requirement, if you're doing, InVITs offer two modes of getting listed. You could get listed through a public offer route, or you can also get listed through a private placement route, which is similar to listed, privately placed listed NCDs. What SEBI has said that if you're doing two different things, the asset mix can be different. So if I'm doing a public offer, I'm getting listed through the public offer route, the requirement is 80% should be in infrastructure assets. And infrastructure assets has been defined under harmonized list by Cabinet Committee, which is issued from time to time. The latest one is, I think, March 2016, where they have listed it out. And it includes lots of different categories of assets, including hotels, etc. Out of the balance 20%, you can only have 10% in under construction project and 10% in other avenues you can invest. But if you're doing a private placement, you could arguably have 100% under construction projects. This 80-20 or 80-10-10 requirement is not applicable if you're going to list your InVIT through the private placement route. The only catch there is that if the assets that you're moving in are under the PPP route, then at least 50% of either the construction should have been completed, or 50% of the financial obligation should have been expended. And that would be based on certification provided either from your lenders or from your chartered engineers, etc. So when SEBI talks about putting under construction assets in an InVIT, they've already by default, by structure itself, mitigated some of the risk, because 50% is completed, then half your execution risk also goes away. And then it's capped to 10%. So that's broadly what the assets can, the discussion on what kind of assets a REIT or an InVIT can have. I'll pause for a minute here. If you have any questions till now, I'll be happy to take up. So let me yes. So where do you feel your confusion is coming from? So if we look at REIT, for example, let's go. Yeah. Yes, that is correct, but that is effectively a subset of, SEBI has put it separately, but that's effectively a subset of 80%. If you have 80% as it completed in revenue generating, then less than 75% can't be in value of assets which are rent generating, right? 80% so SEBI, the way SEBI has drafted is exactly like this. But if you have 80% in completed and revenue generating assets, you'll never going to breach the 75% test. So it's sort of redundant. Correct. So, yeah. And InVITs, again, it's been split into the two different categories if you're doing a private placement or a public offer. And now we can sort of touch upon a little on the process of how you set up or establish a REIT or an InVIT. The first thing, again, like we went back, is it's a trust. So you have to get a trust deed in place and establish the trust. And it's still not a REIT and InVIT or an InVIT till you get a registration from SEBI to that effect. But in the initial phase, it will be a trust established through a trust deed. Now, the way the process works is that before you file, unlike an equity IPO if you were doing, your company has always been in existence. The most you have to do is maybe convert a private limited company into public and then file your draft offer document. But in this case, it's a two-step process. First, where you have to get your REIT or the Invert registered with SEBI. So what is required for that is you file an application. Along with the application, you file there are certain basic details that are required, which is firstly, what are the assets that are going to go into the REIT or Invert, and some disclosures related to the sponsor, investment manager, trustee, their associates, including some details of litigation, etc. And then you have to file that application with all those details along with the drafts of the trust deed, the investment management agreement, and in case of Invert, the project implementation and management agreement. SEBI will review those, give their comments on all these documents. Once they give you the sign off, you go register all those documents and file them with SEBI, and you will get the certificate of registration as an Invert or REIT from SEBI. Now, there are certain things that SEBI checks, basic eligibility requirements that SEBI checks before they grant you a certificate of registration. Those revolve around 2 or 3 important things. Firstly, sponsor meets all the eligibility criteria of net worth, track record, and everything. Second, your investment manager similarly meets all the criteria of eligibility, including net worth, the employees that it needs to have, and thirdly, that its board is at least 50% independent. So these 2 things, if you're not meeting any of these eligibility criteria, SEBI is not going to, and they're very strict about it. We have seen it in our experience where people have said, okay, we will reconstitute the board later on and make it 50% independent. SEBI said, no, I'm not going to issue you a conditional certificate of registration, that it's contingent upon you reconstituting your board. So you do all these things and only then I will issue you a certificate of registration. Yeah, the application is made by the sponsor. So the liability is on the sponsor. Yeah, it's self-certified. But of course, by that time you would have, most sponsors would have legal advisors and at least one investment bank on board who will do their own diligence to ensure that nothing inaccurate goes in. And that diligence will sometimes you will need to see payrolls, etc. Because see, investment manager, let's be clear, everyone's setting up this investment manager only for the purpose of REIT. In many cases, they're like maybe just dormant companies for the longest time, and that can happen more in REIT because there's no 5-year or there's a distinction between the experience of 5-year eligibility requirement for REIT and Invert. In case of Invert, whoever wants to become an investment manager should itself have an experience of 5 years either in infra development or fund management or advisory in the infra sector. So that's a difficult condition to be met. In case of REITs, they have given some flexibility and they have said that whoever wants to become the investment manager, either they should have the experience or one of their associates should have that experience. So that makes it easier. And in REITs, therefore, you will see that a lot of times people will use companies that have been dormant for the longest time and don't even have employees or anything. So that's one critical part where movement of employees and all should happen. And on that, we have seen that SEBI has shown some flexibility as long as you put in your consents, etc. in place that sponsor, if it sponsors employees who are moving to investment manager, if you have consents in place both from from all 3 of them, the employee, the sponsor and the investment manager, that yes, sponsor is ready to let go of those employees, IM is ready to hire those employees, and those employees are fine moving to IM, then SEBI has issued a certificate, okay, your procedural aspects you complete, but give us a guarantee that this is going to happen. And the other thing that I mentioned in the, yeah. So right now, okay, yeah, the dormant entities will be dormant only till before you file the draft offer document. Before you file the draft offer document, you have to activate the investment manager fully by putting in the employees in place, ensuring the board is compliant and all of that. So the decision making actually starts after listing, and by that time the investment manager ceases to be dormant. Under regulations only, it can't be a dormant entity after once you have got your certificate of registration. But initial part, no matter how we would like to describe it, initial plan of which assets will go in, how will the structure of Invert or Reit look like, and all that decision making is done by the sponsor. Ultimately, it's the one setting up the trust. So initial portfolio of assets is decided by the investment, by the sponsor. Yeah. Yeah, so that's what I'm saying. So you will see more instances of that in case of Reit, where the 5-year experience can either be the investment manager or one of its associates. But in case of Invest, that 5-year experience has to come directly from whoever wants to be the investment manager. And therefore, even if you're using an entity which has not undertaken a lot of work in last 5 years, you will have to establish that. And in case of Invest, SEBI has been very, very strict. They have questions. They have questioned how this activity that you are showing as your experience translates into, say, infrastructure development. This doesn't. In some instances, we have seen where there was some amount of grayness on whether you could classify it as infrastructure development or not. And SEBI had questioned it till they were satisfied that yes, what you were doing does qualify as development in infrastructure sector. So that's the distinction. But yes, these eligibility conditions are quite important, and SEBI is going to look at these, and you will have to satisfy them, whether in case of Invade directly or in case of Reit directly or through your associates. One more thing that I mentioned that you have to specify in the application is the assets that you are going to seed into the Invade or you're going to transfer to the Invade. Now, applications are made at a very preliminary stage when people just have this idea that this new product has come up. I also want to set up an Invert or Reit. I like the structure of the project, of the product. But after that, there are multiple rounds of discussions to evaluate what is the correct asset mix, because there will be commercial considerations, there will be input from investment bankers that you hire. If you have done some soft marketing or road shows, you will get some understanding from investors what they expect. And therefore, there is a huge possibility that between the filing of your application for registration of the trust and filing of the draft offer document, there could be a change in the mix of the assets. And SEBI is sort of okay with it, but you will have to for sure go back to them. If you're saying I'm putting in 5 SPVs, instead of that you're putting 6 or 4, then you will necessarily have to go back to SEBI to update them. We have not seen any instance, but I think as long as you satisfy SEBI that the asset mix is compliant with whether that's 80-20 requirement or otherwise with the Invert regulations, they won't have any refiling or other requirements of the application. It's just a process thing. Also, at the point when you file the registration application and even when you get the registration, the ownership of assets will continue to vest in the sponsor. The transfer of assets does not happen before the draft offer document filing or even before the filing of the offer document, the red herring prospectus, so to speak. In this case, which is quite strange, because when you're filing the red herring prospectus, the Invert actually owns nothing. It just have promises or binding agreements with the sponsor that I will transfer all these assets subject to meeting certain conditions. Where SEBI has stepped in and said that you need to complete, sorry? No, there is no restriction on number of trusts that a sponsor can form, but globally, very few instances. I can't recall any, in fact. And also, it will be very difficult to market multiple trusts by the same sponsor with the same asset category. So, just to take an example of one of the filings that has been done, and we're not working on it, Reliance Infra. What they have put in their draft offer document is that they will transfer road assets. Now they have infrastructure business also. When they filed the application, they had said that I'm going to put in my road and my, sorry, I didn't mean infrastructure, I mean transmission assets. I will put both my road and transmission assets in the same Invade. But when they file the offer document, they put only road assets because they're already sold off transmission to Adani. But they, in that case, there is an argument that Reliance Infra could set up two different trusts, with one with transmission assets, one with road assets, and it will be still marketable. But if, for example, you talk about an ITNL or an IRB or Sterlite, it will be very difficult to market. Why am I setting up two trusts within transmission assets? Then I should give a right of first offer, which we discussed earlier, to the existing trust, that if these assets also qualify, you will have the first right of over it. Another question when we are talking about the asset mix that comes up is, actually we'll go back a little bit. There were two questions that that came to my mind from the preparatory material when I was looking at it, and I sort of forgot it at the relevant time. But two things. One is that, can the sponsor be an individual? So there's no explicit prohibition under the regulations that a sponsor cannot be an individual. But the way the tests and the parameters are provided, it will be very difficult to have an individual as the sponsor of the trust. You will reach a position where you will have to designate a company or a partnership or an LLP as the sponsor. That was one question. And second was that in REITs, you can only have commercial real estate assets as your asset portfolio. Again, it's not, regulations don't provide it in black and white, but in India, we don't have a concept where people are setting up real estate projects where they lease them out on whether long or short-term leases. So just to give you an example, for example, when the 2008 financial meltdown happened and there were lots of foreclosures on houses in US, what Blackstone did was went ahead and bought all those houses. Because the valuations were cheap, they were getting the houses dirt cheap. Now they have pooled all those houses. They are not selling those to subsequently to people. Now they've pooled all those houses under a REIT, and they're doing a REIT out of it. So arguably that can be done in India also, but there's no real estate developer who follows that concept that I will build houses and then just rent them out and not sell them off. Everyone just sells it off. So yes, regulations do not prohibit either an individual as a sponsor or residential projects to form part of the asset portfolio of the REIT. So the next part that I want to touch on how once your registration is done, after that is the next step of listing. Now in both cases of both REITs and InVITs, there is a requirement under the regulations that once you get your registration, within 3 years from that, you definitely have to get listed. If you don't get listed, you have to surrender your registration, and if you want to set up a REIT again, then you'll have to go through the entire registration process all over again. And there's a good reason for that, because SEBI and the government in general doesn't want people to misuse this route to take the tax benefit. When this regime was introduced, we got a lot of queries from people who wanted to set up the REIT InVIT structure only for the purposes of getting the tax benefit and actually not doing listing. So unwind the structure after 3 years. For 3 years, I have taken the tax benefits. And lots of advisors, a lot of auditing firms were actually advising on those structures. So to curtail all of that, what SEBI has required is that within 3 years, you definitely have to get listed. Otherwise, no, you have to surrender your registration. Now, listing can be achieved. In case of a REIT, there's only one mode of getting listed, which is similar to what you would do for a normal company incorporated under Companies Act, which is an initial public offer. And there are certain parameters for that initial public offer. which is the IPO size should be 50 crores, the value of the assets that are under REIT should be 500 crores, and there is minimum number of investors that should be there in REIT, which is 200. At least after the IPO, there should be at least 200 investors, and other normal conditions which are similar to IPO, 90% subscription in the IPO, and all of that has to happen. In case of InVITs, SEBI has surprisingly allowed two modes of getting listed. One is your public offer, which again follows the same norms. You have to meet the investment condition of 80% in completed revenue generating, 10 under construction, 10 other avenues, and you have to comply with all other conditions also. But alternatively, if you have a large pool of under construction assets, you could do a private placement. And the norms for private placement are surprisingly very, very simple. You don't have to go through the SEBI review process. You don't have to file a draft of a document with SEBI. You do file the final placement memorandum for record purposes with SEBI. The only catch there is that, and that's a question, that because the ticket size of investing in a privately placed InVIT is 1 crore, and how that will infuse liquidity into the market, because even the trading lot is much higher, is a question that remains unanswered. And also surprisingly, SEBI has come up with an additional requirement on private placements, which is quite counterintuitive, because what SEBI has said that if you have more than 80% in completed and revenue generating projects, then the minimum bid lot has to be 25 crores and trading lot has to be 2 crores, which is against what you would think logically they would do, because if you have 80% in completed and revenue generating, your risk is lower and you should have actually a lower ticket size than a higher one. But that's how the regulations have been amended by SEBI in November. So for InVITs, there are those two routes. Both routes are available, and again that's a question that remains unanswered, and again it's also for the stock exchanges and to have discussion with SEBI. One is that if I am a privately placed InVIT getting listed, or the bidding lot and the trading lot also is different than a publicly listed or publicly offered InVIT that is listed. Now, our stock exchange is going to have two segments within InVIT itself. One is which is listed through private placement basis, one is which is listed through public offer basis, and separate requirements for those, because I don't see how otherwise you can reconcile the different trading lots in the market, or there will be, it's the same segment but some kind of different classification process that they will follow. But that again is a question that will need some working on, and I think I'm sure the stock exchanges are already working on it, because we also have one InVIT in the market which is considering a private placement. And second tricky question in this context is that if I have listed through a private placement route, is it like a institutional board and a main board listing? So if I have to move from private, if it's going to be two different treatments for the listing, then how do I migrate from a privately placed one to a publicly placed one? So that's another question that remains unanswered, because of course if I am a publicly listed, I have other benefits such as lower trading lot and all of that, and retail participation to some degree, not HNI participation is essentially to some degree, more than a private placement, because a private placement can be offered only to QIBs and bodies corporate, and you cannot offer it to individuals or HNIs or other categories of investors, family trusts and all, which are entitled to otherwise participate in a public offer. And on this listing process, the additional key parties involved will be similar to what you have in an equity IPO, which is you will have investment banks who will be coordinating the entire process with SEBI, and you will also have certain other categories of intermediaries which will get involved at later stages, such as the escrow bank, the syndicate of brokers and others, which will form part of the listing process. And on that, there's no distinction that's being made whether you're undertaking a privately placed or a publicly offered InVIT. And also the other thing is that the disclosure requirements, whether you're doing a privately placed InvIT or a publicly offered InvIT, the disclosure requirements, SEBI has now streamlined and said is the same disclosure requirement that's applicable to both. So we'll quickly look at the transaction agreements. One of these days when we were working on the transaction, we just decided to list out how many agreements we have to work on if we are doing an equity IPO and how many do we have to work on if we were doing an InvIT or Reit. In an equity IPO, you normally end up executing 4 key agreements, which are very essential. There could be other commercial contracts and all, but the basic minimum is 4. First, you will do an issue agreement at the time of filing of the draft offer document. Then you will have at the stage of the red herring, you will have a syndicate agreement, escrow agreement, and after closing of the issue, you will have the underwriting agreement. So these are the 4 agreements, that's it. In case of an InvIT Reit, these 4 surely are required because the process is similar to how you would list an equity share. But in addition to that, there are certain other agreements that are a basic norm. One is definitely you'll need to have trust deed, investment management agreement, and project implementation agreement, implementation and management agreement. For the longest time, we thought that these will be boilerplate agreements and there will be no discussion negotiation. But what we have seen transactions, actually, there's a lot of input on these from investment bankers who are actually, so like, this goes back to the question that you were asking. Investment manager is there to protect the interest of the unit holders, but in the pre-IPO stage, he's not really that active. So who steps into the shoes of the unit holders and negotiates on their behalf? So it is the duty of the investment banks to do that. Globally, that's how it is done. Investment banks negotiate these agreements with the sponsor, assuming that as if they were the unit holders, to ensure that all the interests of the unit holders are protected. So these trust deed, investment manager, and PIMA are the basic ones. But in addition to that, you also have to realize, so for example, if I'm a Sterlite today, I'm transferring my SPVs. Those SPVs are going to use the name Sterlite in some form or the other. Who owns the IP? You have to assign a license for that IP to them. Similarly, most of these SPVs don't have a lot of support and other services in-house. For example, they may rely on their holding company because before the InvIT, the main Sterlite entity is their whole parent. So they rely on company secretaries, accounting system, IT systems, even their offices where they are located, all those buildings and all, physical infrastructure, everything they rely on their holding company and holding subsidiary. They really don't have to do much. But once it moves into InvIT structure, you also have to then evaluate, is someone going to put all those systems and everything in place for the SPVs, or you are going to have some kind of a shared services agreement where you, the sponsor continues on an ongoing basis, provide some of these support services. Now these 2 things are also an essential element globally. In India, this product has not evolved as much, but globally these 2 things are also an element of how the sponsor does an additional monetization of his assets, because it's not going to give IP for free. Now in India, we have seen that companies will give it for a nominal or a notional license fee, etc. But globally, they will charge, they will use that as a revenue generation mechanism. Similarly, for shared services, they will have some kind of a revenue generation mechanism from this. But in India, that's still 5-7 years away, because right now the yields are a challenge. So whatever goes out as expense is going to affect the distributions that you're going to make to unit holders. Right now, the expectations are from investors is that the yield should be 3 to 400 basis points above a risk-free return. Now, if you treat risk-free return as GSEC, then you are reaching levels where the yield should be above 10%. And people are already struggling, both in infra and especially in real estate. The returns are actually around 5%. The only reason people might come there is because of capital appreciation that may happen over the years. But giving a 10+ yield is a challenge. So right now, no one's using these mechanisms to extract cash out of the sponsors are not using it to extract cash out of the InvIT. And then the other two agreements is, of course, you are transferring an SPV, so or an asset. So you could do both. You could transfer just the assets if you have ownership of the assets. So if you're looking at an entity like, say, NHAI or PGCIL, sorry, they don't have SPV structures in place. Most of the assets that they operate, the company directly owns. In that case, they will, if they were to set up a Invert, they will have to do an asset transfer. In other cases, in PPP projects, it's all through SPVs, so you're going to transfer shares. So whichever mode you follow, you will need to have an agreement to that effect. And most of the transactions, if any one of you have looked at the offer documents that have been filed, most of them are share transfers of SPVs. The reason is just not that private players normally set up SPVs. The reason also is that it's more tax efficient to transfer the shareholding in the SPVs instead of doing an asset transfer where you will have stamp duty implications. Globally, in places like Singapore, the government has given a exemption from applicability of stamp duty if you're transferring real estate assets to a Reit. So that in India is still far away, also because each state has different stamp duty, and to bring everyone together like we've seen in the GST, it's a massive challenge, or in police reforms, it can never probably happen. So share purchase agreements is the norm. And second agreement that's required is a debt subscription agreement or a loan agreement. And I'll tell you what the reason is. So we'll go back to the structure once. So if you look at this structure, the Reit or the Invert is dependent upon its SP. It will not own anything, but it's dependent upon SPVs. For a minute, let's just keep it simple and not talk about ownership of assets. It's dependent upon its SPVs to generate income or cash flows, which will be upstreamed. Now, we discussed that initially that the challenge, if you're going to rely only on dividend, is your SPVs need to have accounting profits. That's one. And second, if they have accounting profits, they will also be subject to taxation, which is a leakage commercially, not for the government, but of course for those setting it up, it's a leakage. So the way people will structure it is the Reit or the Invert will infuse either a loan or an NCD into the SPVs. And that's how they will extract the cash flows from the SPVs. Because on a loan, they have to service the interest. There's no test of accounting profit or otherwise. As long as you have cash flows, you service. And the related benefit, of course, is that if a lot of money is going out through of the SPVs and servicing interest, then there's no tax actually. And most of these SPVs would, in near term, going to be, or after a certain initial period of few years, going to be loss making largely, at least in accounting terms. Now that also raises another interesting question. Is this what will be the implication when GAR kicks in? Is it tax avoidance? But normally all such structures which are regulated structures and are under certain regulations don't get covered under GAR. But again, there will be a challenge on the rate of interest that you charge, because it can't be exceedingly higher than what is available commercially in the market. Also, you will have to ensure some kind of related party transaction requirements under the Companies Act. And then the third question would be of thinly capitalized companies. That again is a tax question that will come up eventually. So people will structure it in a way that some amount of dividend income comes out, but the majority part will come out through the interest payments. So that's So that's why we need a debenture subscription agreement. And in addition to that, there is, like I mentioned, this is also not a required arrangement, but a ROFO or a ROFR arrangement, where the sponsor grants a right of first refusal or a right of first offer to the Invert over the assets that it's keeping back with it for some reason, such as them being under construction, or there is some shortcoming in their embroiled litigation right now, or any other kind of shortcoming. So the sponsor is globally expected, the investors expect the sponsor to provide some kind of a pipeline in the future to the REIT or the Invert, and that's where the ROFO or a ROFR arrangement kicks in. Not required, I emphasize again, under the regulations, but if you look at the documents that have been filed, not a single one is there which is without a ROFO or a ROFR arrangement. The best situation would of course be a call option by the Invert on those assets, but that's a commercially, the best option would be call followed by right of first refusal, and the last one would be right of first offer, but everyone's actually going ahead with right of first offer and not the most stringent ROFR or call option. And the last one, and then one agreement that's more specific to REITs. Arguably, you could have it in Inverts also, but it's more relevant in the context of a REIT, is a non-compete arrangement. In case of infra projects, you're not going to set up another windmill right next to the or a renewable energy project right next to the other one, and even if you do, it doesn't matter. But in case of real estate, you could actually set up a competing mall right next to the one that you have given it to a REIT, and that's where a non-compete kind of arrangement kicks in, and you may, when working on transaction, have to evaluate whether that's required or not. Capital markets related agreements we discussed. So just to summarize the chronology of listing, this is where we are. And application of registration, then SEBI had introduced earlier a concept of in principle that registration being granted, but that's not being followed strictly. So it could be you file application and get the final registration after executing trust deed and investment management agreement. SEBI has given some leeway on project implementation and management agreement that has to be executed before the filing of the draft offer document. Execution of, then you will file the draft offer document. After you file the draft, the normal process will follow in terms of the SEBI review process. They will give their observations, etc., and that will take time. But that time will also be utilized to execute your other transaction agreements that you had included or in the draft form, or summaries of that were included in the draft offer document. And these are your share purchase agreement or share transfer agreement, NCD agreement, ROFO, ROFR, all these things you will execute before filing. Just execute, not the closing will not happen, only execution will happen before the filing of the red herring with SEBI. The closing of these agreements will happen on or before the day of the allotment of units in the IPO. People want to transfer these assets only when they have certainty that their IPO has gone through. Otherwise, it is a huge cost to unwind this entire structure. So your closing of the entire M&A piece will happen after the issue closes, and after that allotment of units and final listing trading approval from the stock exchanges, access of funds, and the funds. And again, this is again, since we are on the objects of the issue, so to speak, in most cases here would be repaying the external debt. The objective is to pare down as much as possible. So in essence, if I had to summarize, a Invert or a REIT transaction is two things. One, from the sponsor's perspective, one, it is securitization. It's no different from securitization. You're doing exactly the same things, but in a different form and in a more marketable security instead of your pass-through certificates, etc. Second is it's refinancing. You are raising capital at a yield of 10-11% say, but there should be some gap between your commercial lending that you're doing. Otherwise, this transaction doesn't make sense. If you're getting loans from borrowers at 9%, then why would you go and do this entire structure and bear so much cost and pick up funds at 11%? Now, there's a counter argument to it. Again, that goes back to the debate on equity versus debt. The counter argument to that is that you're getting equity at 11%. Normally in market, you'll get it 15-20% IRR, but here you're getting at 11% yield. So even if it entirely doesn't make sense in terms of refinancing, I might still go ahead and do it. and pitch it to my investors as an equity investment, and for the cost of that equity for me is 11% and not higher. Now just to summarize, there are a few differences between, I think most of you would have seen in the preparatory material also, this already covered, but just to broadly touch upon it, the key differences in a REIT and an Invert, firstly is the parties. All the parties are the same except project manager. Project manager is not required in a REIT under the regulations. However, in most practical cases, you will see that a project manager or equivalent will be there for providing property management services and all of that. A business park can't work without someone providing those services, and in most cases that will be a sponsor or a sponsor group entity. The second is nature of assets, which is sort of self-explanatory, that real estate versus infrastructure. The only place where the two meet, or actually where you can do a REIT, include infra and REIT, is where that infrastructure asset is captive to the REIT and is income generating. It should be income generating. That's important to remember. So if you've set up an hotel, it's easy. If you've set up a captive power plant, you will have to establish that power plant is also income generating. Then the lockup requirements we discussed. In case of Inverts, it's 15% for 3 years. In case of REITs, it's 25% for 3 years and then 15% forever. Then experience of in manager or the investment manager in case of REITs and Inverts, where the manager in case of investment manager in case of Inverts has to have experience of its own of 5 years, and in case of a REIT, it can rely on associate. And why I'm emphasizing, put this as an important bullet, is because it gives rise to one important issue which is there in our issues list. And then lastly, the placement options. Even though these differences are there, as a product it's exactly similar, only the asset mix is different. So we are not entirely sure that why SEBI has decided to make that distinction. But on some of these distinctions, SEBI is very firm. So for example, on placement options, a lot of real estate developers have lobbied very hard for SEBI to allow a private placement option where they can put more than 20% under construction assets. But SEBI has been very firm that real estate companies, I am not going to allow you to do a private placement by putting in more under construction projects. So there are some important attributes of REITs and Inverts that we can discuss. I think we don't need to spend too much time or any time at all on investment conditions that have been discussed multiple times. The other requirement is distribution and borrowings. What is required under regulations is that 90% of the net distributable cash flows of the SPV has to be given or distributed to the Invert, and 90% of the net distributable cash flows of the Invert have to be paid to the unit holders. That's a statutory distribution requirement. And the formula for calculating net distributable cash flows has been provided by SEBI in the regulation. It basically just takes out your expense and keeps everything else and doesn't hinge upon the question of profitability. Also, SEBI in its recent amendments, the November 30th amendments, has allowed a two-tiered structure under Invert. If we go back to the chart again for a minute, if you see here, initially when the regulations came in, that holdco structure was not allowed. The Invert had to own the SPVs directly and could not have an intermediate holdco. Even the tax exemption that's provided for dividend distribution tax also clearly specifies that two things. One, the REIT Invert should own the SPV directly, and secondly, it should own 100% of the SPV unless of course those statutory requirements under your agreements are there. But now SEBI has allowed a holdco structure where you can have a holdco in between, and that was again an important ask from various stakeholders, both for REITs and Inverts, because the way otherwise people had to do a lot of work to unwind or merge or subsume existing structures. In real estate and infra both, you would see that there are multiple holding levels and multiple SPVs, and it was becoming very difficult and cost inefficient to merge all of those together, and holdco structure was easier. SEBI has allowed that, but with a condition, with an additional condition that 100% of the cash flows of the holdco, which it gets from SPVs, have to be upstreamed to the Invert. Holdco is also entitled to do some little bit of its business on its own, which is incidental to its holding of the SPVs or being a holdco under the Invert. And for that, whatever it generates from that, 90% of that has to be upstreamed. So slightly different requirement. If you're directly holding SPV, 90% has to go to Invert and 90% of that goes to the unit holders. If there's an holdco in between, 90% of SPV's cash flows go to holdco. That entire 90% is like a pass-through, goes up to the Invert. Whatever the holdco generates, 90% of that goes up. So that's the only distinction that is there if you're having a holdco structure. And of course, you will, like I mentioned, that the DDT benefit is only available if you have a single layered structure. So if you're going to go with a holdco structure, the DDT exemption under Income Tax Act would not be available. But again, that's not a deal breaker for most of the transactions we have seen, because like we discussed, no one's going to pay too much dividend. So even if it's taxed, it doesn't really affect the commercial viability of a REIT or an Invert. Then the other important requirement is on borrowings. What SEBI has required is that the leverage or the deferred payments and borrowings of the Invert on a consolidated basis cannot be more than 49% of the value of the assets. Again, this is a good reason for it, because these structures are not in place where you are servicing huge amount of external debt and you don't have enough left after that to make distribution to your unit holders. If you want that structure, then list an equity share and then don't give any dividend to your unit shareholders forever, and the price movement takes care of it for speculative or other reasons. But here it has to be assured income generation and therefore not a high level of leverage. Again, there's a sub condition under that if the leverage is more than 25%, then you have to take unit holders approval. The question that repeatedly comes in this on this point is, at what point does an Invert or a REIT have to comply with it? Because prior to getting access to the funds in the IPO and utilizing that for paying external debt, most of the companies will be in infra 80-20 in terms of debt equity ratio. This is how, using issue proceeds is how they are going to pare it down. So what the regulations require is net of cash and cash equivalents. So once the IPO proceeds move into the account of the Invert, then that reflects in your financial statements as cash and it's netted off against the leverage. And you will on day one be compliant with the 49% requirement. And on day one, you should be compliant with the 49% requirement. On an ongoing basis, if subsequently you breach the 49% requirement, then there's a 6-month grace period that has been provided by SEBI. You have to bring it back down to 49% during that. The other important thing is valuation. Valuation in itself is an important component. You have to get valuation done at every stage. Before the IPO, there has to be or the private placement if you're doing, in case of Invert, you need to have a valuation of assets done, and that valuation report is annexed to the offer document. On an ongoing basis after you're listed, for any acquisition or divestment of assets, again you have to, apart from annual valuation has to be done of all Inverts and REITs and disclosed to the public unit holders. But after, if you're undertaking any acquisition or selling of any of your assets, then there are certain caps beyond which you cannot sell or buy it. In case of a sale transaction, the price cannot be less than 90% of what the valuation report says. And in case of acquisition, it cannot be more than 110% of the valuation. The only, if you are going to and commercially there's a possibility that you want to acquire a project at more than 110%. So SEBI has given a way out for that also. Then in that case, you take a unit holder's approval, and accordingly, then if unit holders approve, you can go ahead with it. This is slightly different in case of REITs, this acquisition valuation or disposal valuation requirements in case of REITs. So if you are doing an acquisition or disposal to a related party, then you have to the REIT will have to get valuation done by two valuers and take the average valuation price and then apply the 90% and 110% limits. Then the next point is related party transactions. Again, related party transactions have been treated very stringently under these regulations, because on an ongoing basis there will be a subsisting relationship between the sponsor and the InvIT or the REIT, and SEBI doesn't want, or the regulators globally don't want that to compromise the independence or the interest of the public unit holders. So the thresholds for this is that if in a given year, and it's slightly, again, there's a distinction between how REITs and InvITs are treated, but in case of InvITs, the requirement is if the value of acquisition or disposal is more than 5% of the value of the InvIT's assets, then, or the borrowings that you have taken from a related party are more than 5% of value of the InvIT's assets, then you have to take a unit holder's approval. In case of REIT, that is a 10% requirement. Other key considerations, again, first point we've discussed, but the legal framework, please be mindful whenever you're evaluating REIT or InvIT, is that don't forget the trust law. Even lawyers don't study it in too much detail in law schools, don't practice it enough, but it is of paramount importance in these structures. Second, if you are used to doing a normal capital markets transaction, please remember that this is an M&A first and foremost. So all the checks that you would do for a typical M&A transaction, you need to have all those checks done, whether that's implications of FEMA, foreign owned controlled, Indian owned controlled questions, or pricing of for transfer of assets, or any RBI approvals that may be required, any consents that may be required, all the processes that you would follow for an M&A, just ensure that you have to do it here also. Due diligence. On due diligence, the threshold for doing or the standard for doing diligence on the initial portfolio or assets is exactly the same as you would do for a company doing an equity listing. There is, however, depending upon the ROFO arrangement for pipeline assets, there should be some limited diligence done on those assets also. At least the basic ones, that they have basic approvals and all those things in place. What is the status of project, environmental approvals, any key litigations that are there. So these broad 3-4 financial closure has happened or not. These 4-5 key points you need to be mindful that you have to do a due diligence on the pipeline assets also. Now is the most interesting part. There are more than 10, but I've listed the 10 most important issues that affect the listing or a successful listing of a REIT or InvIT. First and foremost is whether a unit of the trust of a REIT or InvIT, whether it's a security or not. Any volunteer? Any thoughts on whether it is a security or not under SCRA? That's exactly SEBI's argument. I hope you're not working for SEBI. No, so if you ask a lawyer like us, sorry? Yes, but if you ask a lawyer this question, he will say that security is defined under Securities Contracts Regulation Act. And under that definition, it's not covered. So as we talk today, it's not covered under definition of security under SCRA, even though SEBI has a different view, and I'll explain what that different view is also. So what SEBI says, the definition of security says security includes A, B, C, and any similar instrument or by whatever name called of or marketable security of a body corporate, of a company or a body corporate. So SEBI in its wisdom believes that trust is a body corporate, and that's where we disagree with SEBI, that trust is not a body corporate. It's just an obligation. Trust does not have any legal existence. It cannot sue or be sued. It cannot hold any property. It cannot hold any assets, nothing. Everything is done by the trustee. The security that you are issuing is not a security of the trustee. If it were a security of the trustee, it would get covered under the definition. It's a security of the trust, and the trust is not a body corporate, and therefore under the current provisions of SCRA you would not get covered. Now the counter argument that SEBI has to that is that the definition of security is strangely worded because it says securities include, and according to SEBI that's an inclusive definition, and therefore anything and everything is a security. But that's not the intent of law, because even though it uses the word inclusive, it is set out specifically the 10 or 15 things that it considers to be securities, and it cannot be that everything is a security just because of it's an instrument similar to a security. And the third argument SEBI has is by its correct. Yeah. Yes, it has to be. It can't be an inclusive definition. Yeah, yeah. And then the last argument that SEBI has, that in its nature, this is a collective investment scheme, and units of a collective investment schemes are covered under the definition of security. Now, which is a fine argument to take, but then all that is required is to issue some kind of a clarification that REITs and Invits are a specialized kind of collective investment scheme, and accordingly, even though they are collective investment scheme, they don't need to comply with the collective investment scheme regulations. Because once you go down that path that REIT and Invit is a collective investment scheme, then you are in dangerous territory. There's a full regulation that requires many difficult things to be done if you're going to set up a collective investment scheme. So this is one thing that we are working on, and it has a serious implication, because, for example, how will you list it if it's not a security? Exchanges will list it. How will, say, a commercial bank invest in it, because their mandate is to invest only in securities? How will a mutual fund invest? How will a insurance company invest? So that's a very basic, goes to the root of how we treat these instruments, and hopefully we'll get some resolution to this, but till now it's been a uphill task. Second, sorry. So you're right, it had happened when the IDRs were introduced, the Indian depository receipts. At that point in time, again, there was a challenge on it not being covered under the definition of security. And why? One more point, that why SEBI is reluctant to amend that definition is because it's an act and it has to go to Parliament. So SEBI can't do it. And that's why they are reluctant, and they're trying to fit it into an existing framework somewhere. And that's the same challenge they faced when the Indian depository receipts were introduced. Ultimately, they were specifically included in the definition, but initially at least SEBI had issued a circular where the intermediaries, at least that they regulate, they have said that for their purposes, such as mutual funds and all, this will be treated as a security, and they're allowed to invest in units of IDR. Yeah, I think, yeah. Yeah, I think where they've said inclusive, they need to add one more point and saying any other instruments as may be notified by SEBI from time to time. Just delegate it to SEBI under the Act itself. then it's easier for SEBI to do in future also. We don't know what new products will come in. And even under Companies Act, lots of things are delegated to SEBI. All the procedural things related to issue and listing of securities, payment of dividends and all is delegated to SEBI. So it's not without a precedent where this can be done, but it has to be done. The second is, again, is a huge challenge, and a lot of times it's not appreciated at the beginning of the transaction, is where you have a listed sponsor. So we have right now, if you look at the transactions that we have that have been filed for InVids, there are multiple out of them, IRB, ITNL, etc., which have listed sponsors. Both ITNL, IRB, both are listed companies. Now, when you start this transaction, when you start sharing information, those assets are still owned by the listed sponsor. And therefore, all the requirements of insider trading code and their policy, that listing regulations, all that kicks in. And it becomes a massive barrier to share information and proceed with the transaction. In India still, even though it's now under insider trading regulations, recognize that NDA, or if you're non-disclosure agreements, or if you're doing it for valid business purpose, are now finally recognized as a defense, but we don't have enough jurisprudence on that, on how it will be treated, whether that's adequate or not. There's still risk to the sponsor. So this is one challenge that is a big issue. Also because in case of InVids and REITs both, there is a requirement that next 1 year's projection of cash flows and revenue you have to include in the offer document. Now today, assume for a minute that I have filed a draft offer document with all those projections and all, but the InVid transaction doesn't go through. Then it's guidance on my own stock that I have given, and I'll have to either live up to it or bear the consequences. So it's multiple problems at multiple levels. So in case, for example, we had to come up with ways in which this is addressed. So for example, in case of ITNL, if you go through their stock exchange announcements, they have uploaded something called a transaction update note. The purpose of that was to launder the entire information that has been shared before they go to for the road shows, because they have to start the road shows before they file a placement memorandum. They are doing a private InVid. So before they file the placement memorandum, they have to hit the road shows. There will be research reports that will be issued. So how do you make that information public? The research analyst cannot include anything in their research reports which is not in the public domain. That's under the research analyst regulation. So what ITNL came up with is a transaction update note, which gave the key features of the InVid assets, including projections, financial statements and everything. Now there's another problem with that, is that before an offer document, whatever you upload should not be considered or treated as solicitation of for investing in your securities. Now if you put issue details in that, then it amounts to solicitation of securities. You're doing it on a private placement basis. You have made it available on your stock exchange with all the issue details. If that is not solicitation, then what is? So therefore, if you look at their transaction update note, it only talks about assets. It doesn't talk about IPO procedure, process, how IPO will work, and some of the things that are not price sensitive information, such as litigation of some associates, etc. All those have not been disclosed because the call has been taken by their company secretary that none of this information is actually price sensitive and can be shared. So that was just by way of an example, but there could be more difficult challenges, especially if you're doing a InVid on a private placement basis. In case of public offer, you at least have some protection under the draft offer document. Once you've filed, that draft offer document has become public, all information is in public domain. And this problem we also faced when we were doing Religare Healthcare Trust. Again, there was the same problem. Fortis was the sponsor of Religare Health Trust in Singapore, and Fortis was a listed company in India. Again, the similar arrangements had to be put in place, but this is a challenge, and there should be, I don't have an answer how to solve this problem, but at least some of us should be thinking, including SEBI and the stock exchanges, on how to address it without undermining the investors' interest, the public shareholders' interest in the sponsor. And third problem is identification of investment manager and InvITs. If you recall, I had mentioned it in the beginning. Why it is a problem is the 5-year experience that it has to have on its own. Now, most of the entities that a sponsor has access to, who will have 5 years experience, are the SPVs. They are going under the InvIT. You can't make the SPV itself the investment manager. So people have and continue to struggle in identifying an investment manager for InvITs. It's a big challenge and a big issue. SEBI in its draft press release, which it issues after every board meeting of its board, had indicated that they will bring it in line with the Reit regulations, where the investment manager can rely on the experience of his associate. But again, they have not done it in case of InvITs. And again, I personally don't know what is the reason for making this distinction between REITs and InvITs. Then REIT and InvIT has to have controlling interest. This point we discussed in the SPVs. So other forms of economic interest, etc., is not recognized. 51% is required. And the second, tied in with that, is there can't be any multiple classes of units or preferential or other beneficial rights on any other units. And why it's a problem is, again, goes back to the shareholding transfer restrictions. Today, even if I can only transfer 51%, I can contractually pass on the entire economic benefit to the InvIT, even for the 49%. But that is not, by SEBI, that is not recognized as an adequate form of control, and therefore you need to have necessarily transfer 51%. On multiple classes of units, SEBI has given at least one exemption, which was again a significant stakeholder demand, is the ability for the sponsor to forego its distributions for a specified period of time. Earlier, even that was not allowed, and a lot of sponsors were keen that I don't want distributions for 4 years. Let it reflect in a high yield for public unit holders till the product stabilizes. After that, I'll start taking my. If you were not allowing multiple classes of units, many lawyers were taking a view, then you can't even have a contractual arrangement, even though we as a firm were of the view that you can contractually go ahead and do that, because no one stops. It's your right, and you can assign your right to anyone. It's not an obligation on you to receive distributions, and therefore without having multiple classes you could contractually do it. But now SEBI has clarified it completely and said you can actually have a separate sponsor unit, so to speak, which does not receive distributions for a specified period of time, but it can only have inferior rights, not superior. I think one slide got deleted. Okay, sorry, I pressed back. ROFO we have discussed in detail, but I think is that adequate or not? It's a question again. We would have expected, and when we were advising on consultation papers, that in India it is best if you prescribe this under the regulations. Now it's voluntary. People may or may not do it. And right now, because everyone's pitching to sophisticated investors because of a certain ticket size, it's still, people are being forced to provide this. But over time, when it moves towards retail participation, people may not follow this or adhere to this strictly. And this is one thing that SEBI should really look at and make this requirement mandatory. Detailed unit holders approval process is the next point, and there's a vague requirement under both Reit and InvIT regulations, which says that if anything is outside the ordinary course of business, you take unit holders approval and you give an exit option to the dissenting unit holders. Now that's incredibly ambiguous and vague. What is ordinary course of business or not? There's already a massive debate under Companies Act 185, 186 on what could be treated as ordinary course of business. And here we have another thing, without adequate jurisprudence on or any judgments on what is ordinary course of business, you have put this term in. And again, no benefit to unit holders, because everyone will decide everything is in the ordinary course of business. Transfer to assets, like I mentioned, has to be done prior to allotment of units in the IPO. Now, the problem with that is the InVIT is purchasing those assets by utilizing the issue proceeds. It will not have access to the issue proceeds under the regulations till it gets final listing and trading approval from the stock exchanges. Now, what do you do? I mean, and the only possibility is to do some kind of bridge financing, which in itself is a challenge, because banks can't finance you for acquiring securities or shares or investing in shares of other entities. So it's becoming a little bit of a challenge, not so much on the transactions that are currently active, because in all those cases, the consideration is being paid in the form of units. The sponsor will, because sponsor also has to hold 15 or 25% depending upon Invert Reit, so they are being paid in the form of units and not actually a cash payout. And also the cash payout is tax inefficient, because it will be, that cash will be taxed in the hands of the sponsor, but units are not. So that's going to be taxed only when they actually sell those units in the market. And then also if they hold it for 3 years, which they are mandatorily required under the regulations, they will only be liable for long-term capital gains. So therefore, we are not facing this problem, but it's going to come in the near future when people don't pay only in terms of units. If the value of assets is more than 15% of the units, I'll have to pay some cash also. And sponsor doesn't want to hold even 1 unit more. And at that point in time, we'll have to review this. And the related question to that may be that how do people address it in jurisdictions outside? Are they allowed to transfer assets after listing, or how does it happen? In other jurisdictions also, like Singapore, it's required that before you get listed on the exchange, you have to transfer all these assets. Not before allotment of securities, but before listing of securities. So there's a leeway of 1 or 2 days there, and only financing, if at all bridge kind of financing is required, is only required for a matter of hours, because in Singapore listing happens this also the stock exchanges have done consciously, that listing of units of a business trust or REIT happens in the evening, 4:35, I think 4 o'clock or something, and then you just need financing for a very small overnight period. In the morning you take financing, and then you are done with the listing, you have the money and you transfer assets. So maybe some mechanism of that sort will be evolved in the exchanges here also, where you can meet that, but that would have been helpful only if you have to do it before listing and not before allotment. Role and liability of the trustee we discussed. The trustees in our experience are grossly underprepared. They don't know what they've gotten into. A lot of them have quoted at a very aggressive fee. They will have to put in lots of systems and people in place to monitor REITs and InVITs, and they are perhaps, as the entire structure stands today, they are the weakest link in this entire structure, and that is something that really needs to be addressed. They are going on a path where they're saying everything I can delegate to the investment manager, I don't have to do anything. But that's not how InVIT or REIT structures work globally, and that's not how even our regulations are drafted. A lot of stakeholders had given inputs, including our firm, to SEBI, that like other global jurisdictions, you merge the role of trustee and manager into one. So there will be only one entity who's the trustee manager. He's also the trustee for purposes of ownership, and he's also an investment manager for taking all the decisions and running the REIT or the InVIT. But SEBI in its wisdom, and because of very strong lobbying from debenture trustees, they decided to keep these two roles separate, which has created it's created a lot of problems, because it's a challenge. Every agreement, every document that has to be signed on behalf of the trust should be signed by the trustee. He is the only one legally entitled to. He cannot delegate it to someone in the absence of a proper power of attorney, which means this almost the same thing as him signing himself. And here the trustees are taking shelter under the regulation and saying, I'm allowed to delegate everything to the investment manager. He'll only sign. I don't want to sign anything. I don't want to sign the offer document. Is the offer document issued by the trustee on behalf of the trust, and the trustee is not signing the offer document. So all of these things will, today, if your listings happen successfully, all is fine. If even one or two of them go south and result in some kind of litigation, it's a mess to get out of. And then the lastly is the preparedness of various other stakeholders such as concessioning authorities, lenders. Everyone is struggling, and rightly so, in understanding this product and evaluating whether, so you need consents from lenders, you need concessioning authorities. Before giving those consents, they are not able to gauge properly whether it's beneficial for them or is their interest being compromised somewhere. And then concessioning authorities may come up with conditions which the InvIT may not be able to comply. Important things that are currently pending. We are almost at last two slides. The important things that are currently pending: one, the operational procedure for doing a quip or a bonus issue or a rights issue or a pref allotment is not provided under both Invert and Reit regulations. SEBI again has worked from a premise where they have treated this equivalent to a company, but for a company everything is provided under Companies Act. So even if you don't have ICDR, you have Companies Act to rely on. In this case there's nothing. The Trust Act doesn't even envisage a trust issuing securities. So you can't go back to the Trust Act and look at all of that. And related to that is also migration from the main board, from whatever private place board to the main board. And the biggest one is how will the work of winding up and delisting work, because infrastructure assets, limited life. There's a huge possibility that after 25-30 years you'll have to wind up the InvIT. And how will that process work? There's absolutely no clarity on that. Then SEBI has recently notified amendment to mutual fund regulations where mutual funds have been permitted to invest. Now that has created its own set of complications for two reasons. First, SEBI has not indicated whether it treats it as debt and equity, the point that we discussed earlier. Second, what is provided under mutual fund regulations is that if your fundamental attributes of your scheme are changing, then you have to give an exit to the existing unit holders without any exit load, which is a very significant requirement, and no mutual fund will be encouraged to invest in these products if they have to go through that process. So again, there's some amount of discussions happening where this should not be treated as a change in fundamental attribute of a scheme, because a scheme is entitled to invest in equity, and that question would have been easily addressed if you answer one way or the other, this is equity or debt. But again, that's in a bit of a limbo. And second, till today, insurance companies are not allowed to invest. So IRDAI has to come up with amend its investment regulations to allow insurance companies to invest. The only requirement, and SEBI had in one of its consultation papers indicated it, what clarification IRDAI requires is from SEBI a confirmation that the liability of unit holders will be restricted to the units that they hold, and the trustee cannot call for more money from them in case anything goes wrong. Now SEBI principally agrees with it, and even under the Trust Act broadly it is fine. Only thing that the trustee can ask for additionally over the fees agreed is that if it undertakes certain additional expenditures, etc. So, but that because that clarification has not come from SEBI, IRDA has not notified the investment regulations governing investment by insurance in REITs and Inverts. That's about it. And these are some of the important amendments which happened. But the big one in that, I think I'll touch upon 2-3 which are the big ones. One is the definition of associates. The regulations require that litigation details of associates have to be disclosed both in the application and in the offer document. Not just the associates of the INVIT, but associates of the project manager, investment manager, trustee, and the sponsor. So it was and the definition was so widely worded, it was a massive universe. Now, SEBI has cut it down, brought it in line with Companies Act largely, and also said that trustees, associates details you don't need to include because that's a completely independent entity. Two-tiered structure we discussed, they have allowed. Related party again was a very expansive definition, covered, that again also covered associates of trustee also as a related party. Now again they have aligned it with the Companies Act and made it far more simpler. And the other one was any unit holder holding more than 20% was also treated as a related party. Now that's been dropped. Limit on number of sponsors. Earlier there was a cap, you could have only 3 sponsors. Now they have removed that cap. And in case of REITs, they have also introduced the concept of sponsor group. So the unit lockup requirement that's applicable to sponsor can be either sponsor or sponsor group in case of REIT, but in case of INVIT, again, distinction for God knows what reason, but yeah, in case of INVIT, only the sponsor has to provide that lock-in requirement. Minimum public offer was the other big thing, because earlier it was a blanket provision which said you have to do a 25% public offer. Now they have aligned it with SCRR. So if you are doing less than 1600 crores IPO size, then you have to do 25%. If you're doing between 16 to 4,000 crores, you have to do at least 400 crore IPO size. And if you're going doing more than your valuation is more than 4,000 crores, then you have to do a 10%, but bring it in line with 25% over a period of 3 years, which is similar to what is applicable to equity shares. Then I think the other 2 big points are the last but 2 bullets before that. Power to relax strict enforcement of regulations. This seems very innocuous, but is a very, very important thing. Most of the SEBI regulations have inherently this power with SEBI where they can waive off certain requirements under the regulation. It was conspicuously absent from both INVIT and REIT regulations. And this was a challenge when people went asking for certain exemptions. SEBI said under regulations, I don't have any power. Now they have amended it to include that power for themselves, so that if you need on certain operational matters some exemptions, etc., SEBI has the ability to grant it. And minimum subscription, unlike equity IPOs, was 75% in both REITs and INVITs. Now they have aligned it with equity IPOs and made it 90%. That's it. Others are specific to REITs and INVIT, the important recent amendments, but they are largely operational and doesn't change anything dramatically. But you can have I'm sure Mohan sir will share the presentation or whatever the process, so you can go through these and happy to address if you have any questions. So that's all from my end. Happy to take up any questions that you may have. FPIs are allowed. Yeah. Yeah. So no listing will happen till mutual funds or insurance companies are allowed to invest. No listing is. Soon, we are hoping that. Earlier our hope was this financial year, but that's moved to April, May. But yeah, as soon as that. Some of them have got actually very good investor response. The only, and that's where your question comes in, the only gap now left to close the book is domestic financial institutions participation. Foreign investors are very keen because low interest rates globally. It makes sense to have a 11% yield in India instead of 0% rate of interest in Japan. So no listing till insurance companies and mutual funds are allowed. You've asked a very good question. I don't know if you read the regulations to ask this question or not. SEBI has muddled this valuation exercise completely. What was required is the valuation of the Invert. That has to be done. So you have to value the assets. Obviously, you'll have to go to the SPV level and value the assets and everything. That will be reflected in their valuation. Now, SEBI amended earlier definition of valuer was whatever Companies Act provides will be the same applicable in this case. Now, they've amended and said in case of financial valuation, a valuer would be a CA firm, merchant banker. In case of technical evaluation, it will be an institute of engineers or institute of surveyors or similar entities. There's a long list of 10, 11 entities. A problem with that is they have, on top of that, they have said that you have to get both a financial and a technical valuation done. Now, in whoever's eligible to be a financial valuer will never going to be eligible to be a technical valuer and vice versa. Now, does that mean that you have to get two valuations done? I don't know. I don't have the answer. The way it is drafted, you need to get one valuation done. Till now, everyone has got one valuation done, which is largely financial valuation, which includes aspect of technical competence. You can't do a financial valuation till you look at the technical parameters also. So it's the same valuation exercise, but got a little muddled right now. So some clarity is expected, hopefully, on that. But it will be a financial valuation largely. Okay, thank you, sir. Also, a firm had published, this is, you must have seen, you see that logo on the corner, 100 years of value. So this year our firm completed 100 years. As part of our celebrations, we've initiated a series of publications. And the first one that we did is on Reits and Inverts. We have a few copies if anyone's interested. You can, please.
Thank you, sir, for the insightful lecture. For the information of the participants, the next lecture is scheduled for 20th of March, which is a Monday, and the topic that will be covered is competition law. Thank you.
And if anyone of you needs soft copies, please reach out to us.
The next one,
20.
competition law. We have his permission to distribute the
Yes.
results. We can do that tomorrow.
I have a copy. There are soft copies. Thank you.